Hello everyone, welcome to you on Think Future Academy channel. Today we will cover the budgeting process for smart, modern companie SAL. Introduction. Budgeting may be a time-consuming and tough procedure. There are questions to be answered, puzzles to solve, and groups to consult with. As a result, budgets are frequently postponed until they are too late or never completed, while on the other side, extremely prescriptive, downright pedantic budgets exist. Those that account for every minor cost, handled over a suite of spreadsheets that most users don't grasp. This is certainly preferable to no budget at all, but it can cause a lot of problems along the road. This information will assist you regardless of whatever side you take. It outlines the elements of the company budgeting process to ensure you're doing everything necessary. It also contains best practices and principles to guarantee you're doing everything correctly, no matter how basic or complex your budget is. Because your business needs a budget. However, you must decide whether it is effective, beneficial, or simply a waste of time. Budgeting processes. The budgeting process allows an organization to plan and prepare budgets for a certain period. It entails going through previous budgets, identifying and estimating income for the next period, and allocating funds to spend on a company's different expenditures. When done correctly, the process involves top management, your finance staff, and budget managers from across the firm. Consider your budget to be the implementation of your company plan. You've determined the company's priorities and goals for the following year, and the budget distributes financial resources to achieve these. Importance of business budgeting. The benefits of budgeting are very evident at their most basic. If the firm runs out of money, the business cannot continue. As a result, a clear cash flow strategy that all teams can follow is critical. But, aside from preserving the business's survival, there are numerous compelling reasons to value your budgeting process. It is helpful to establish clear goals and expectations. Your budget establishes expense and revenue objectives, which assist other teams in tailoring their efforts to meet them. It is critical for funding. If you approach venture capital firms or a bank for more funding, they will want to know how you intend to spend it. They'll also want to see that you've previously created and adhered to budgets. It concretely states your priorities. To some extent, your teams are going to set their own deadlines and time frames. The budget provides them with broad principles for this, and including them in the budgeting process allows them to do so sooner. It keeps unpleasant topics at bay. Individuals will always have novel ideas and campaigns in mind. While this is recommended, your budget provides you with hard figures to keep expectations in check. It connects finance teams to the rest of the organization. This is an integrated process that involves involvement from across the organization. Finance will learn more about the goals of other teams and then provide organized suggestions. The most obvious advantage is that budgets provide businesses with more control and visibility over expenditure. Key budgeting steps. There is probably no one right way to create a business budget. But to guide you through the process, here are 8 important steps to follow. Let's take a closer look at each in turn. Number 1. Review the previous period. Number 2. Calculate existing revenue. Number 3. Set out fixed costs. Number 4. List variable costs. Number 5. Forecast extra spending. Number 6. Scrutinize cash flow. Number 7. Make business decisions. And number 8. Communicate with it clearly. Now we will discuss each step in details. Number 1. Review the previous period. The first step should always be to go over the existing information you have. In this scenario, the old budget provides the greatest evidence for how your new budget should be implemented. Consider the following. 1. Did you spend more or less than anticipated? 2. Were your assumptions about the industry and your own growth accurate? 3. Were there unexpected hurdles or shortfalls, and what caused these? 4. Was the budget easy to enforce? Did team members follow it? This should be done at a high level for the entire organization, and individual budget managers, if you have them, should be encouraged to do the same for their scopes. Consultation with other team leaders is also essential at this stage. The finest budgets, as we'll see, are collaborative, and you need to know how well the prior budget worked for everyone involved. Number 2. Calculate existing revenue. The most obvious beginning point for any budgeting exercise is determining how much money you have available. Of course, there will be other expenses, but we'll get to those later. Income streams must be identified at the corporate level. How much money do you make in total? List your main items, their prices, and predicted volumes for the future year. Naturally, this includes some guesswork and will not be flawless. You'll be spending investor funds or venture debt on firms that aren't yet profitable, or don't have any paying customers at all. So, at this step, you must determine your burn rate, how much of the overall investment you are willing to devote for each period. Number 2. Calculate existing revenue. Fixed costs, often called overheads, are those over which you have little control. Most importantly, they're not impacted by your sales. Whether the business succeeds or not won't have any effect on the amount you pay. Fixed costs can include rent or mortgage payments for office space, website hosting and servers, employee salaries, insurance, interest on loans, utilities, such as electricity and internet. You may safely prepare for these expenditures if you know your personnel headcount for the year and have your office space and insurance in order. As part of this process, it's important to learn crucial payroll terms so that you don't get tripped up by misunderstandings or a lack of expertise, especially when it comes to estimating staffing expenses. Number 4. Add variable costs. Variable costs are usually thought of as discretionary expenses. As opposed to fixed costs, these are more fluid and can be tinkered with. Examples of discretionary expenses include marketing and advertising, corporate investments and donations, software subscriptions, particularly where they aren't critical to running the business, travel and client meetings, team perks, office decor and renovations. The term discretionary does not imply that these expenses are frivolous or unneeded. A company cannot develop without marketing, and team benefits may help keep employees satisfied for extended periods of time. However, when developing a corporate budget, these changes must be justified more rigorously. And, when you're about to go over budget, variable costs are frequently the first to go. Number 5. Forecast additional spending. Are there any one-time charges on the way? These might include a significant merger or acquisition, professional assistance in preparing for an audit, or simply a once-in-a-lifetime event or party. If feasible, attempt to budget for these erratic costs separately. You must account for them in your budget, but they will not be a critical component for many years. Consider creating a rainy day fund. Because the only certainty is unpredictability, it pays to have some money set aside in case something unexpected happens and you need a safety net. Number 5. Forecast additional spending. This is the point at which the budget analysis begins. You should now have a clear record of planned revenue and costs, and preferably one for the preceding period as well. Was your expenditure in line with your expectations? Have you had regular revenue over the previous year, or have you noticed seasonal effects? The term cash flow refers to the interaction between money flowing in and money leaving. You want to know that you're spending money that you've planned for, and that if your income falls, you can adjust your costs accordingly. Look for obvious clues that specific areas of your budget may require further attention. You should be aware of the specific components of your organization that have the most influence on the budget and be prepared to modify them accordingly. Number 7. Make business decisions. Naturally, you must now apply all your previous research and planning. That includes developing a detailed spending strategy for the future. Google Sheets provides an excellent annual budget template, and the balance has a basic one. Of course, the most difficult element of the process is determining which projects or priorities receive money and which do not. This may be a stressful situation, so we've included some best practices to help. Most importantly, attempt to maintain a consultative approach throughout, solicit feedback and depend on the knowledge of your talented team members to lead you. You'll probably make updates and modifications during the year, so rely on the data you have now and don't get too bogged down. Number 8. Communicate with it clearly. The final step is to communicate the budget with your staff and ensure that they understand what is expected of them. You'll probably rely on many team leaders to manage their own expenses, and they'll need the right tools and expectations to do so. Does everyone know how much money they can spend and on what? Do they also understand how to track their expenditures as they go? If you can't respond yes to both of those questions, you'll probably struggle to track and assess the efficacy of your budget. Then there's communication. Budget day is the most important day of the year for many governments. There's a reason politicians take the message so seriously. And, while you're at it, business budgeting best practices. Now that we've set out the process, let's also consider some principles to apply along the way. Here are a few excellent suggestions from around the web. Think of assumptions before numbers. Consider your KPIs. Avoid 3 don'ts. Revisit regularly. Now we will learn in detail about business budgeting best practices. First is, think of assumptions before numbers. Naturally, your budget will be filled with numbers and statistics. However, it is frequently a good idea to begin by explicitly stating what the budget is based on, created for, and how it should be read. When you think of a budget, you probably think of spreadsheets with a lot of numbers, says Hal Sheldon. The assumptions that underlie the computations are more essential than the numbers themselves. As a result, the first page of your budget should include these assumptions. What products/services are being offered? At what pricing and volumes? And what the primary drivers for spending are, such as the number of workers and locations, various marketing campaigns, and so on. Number 2. Consider your KPIs. It is critical that your budget, particularly the variable expenses sections, represent the company's overall aims. So, make an effort to link your spending to your goals, and keep track of your progress when the budget is released. When it comes to budgeting, key performance indicators, KPIs, help steer you in the proper way. KPIs may help you plan the tiny aspects while keeping the overall picture in mind. The problem is determining which KPIs should be considered. Common KPIs for setting a budget plan often include operating cash flow and expenses, sales and marketing initiatives, payroll expenses, return on equity, burn rate, accounts payable and receivable, turnover rate. Just make sure that your KPIs are clear and can easily be measured. Number 3. Avoid these 3 don'ts. It's always good to have a few areas to watch out for. And even though you may already have these 3 factors in mind, they're worth repeating. Don't over-exaggerate estimated revenue and profit. Don't forget taxes, including sales taxes, state and federal taxes. Don't forget seasonality. Business could be going great one month and slow the next. Last, number 4. Revisit regularly. A budget is not something that can be set and forgotten. In fact, as the year continues, you should revisit, assess, and alter your expenditures. That is why you should arrange budget reviews on a regular basis. I propose starting with a monthly evaluation and then moving to a more convenient timetable. Every month review can help you spot weaknesses in your strategy, particularly if you don't have much expertise in this area, and evaluate how solid your business is. If you find that you don't need to update your strategy very often, you may start evaluating it every 3 or 6 months. You could even discover that you have more accessible cash than you expected. And business budgets go hand in hand with spending management. At this point, you know the ins and outs of effective business budgeting. The next step is actually using it for more effective company spending management. Consider the following. How will you easily monitor where each payment goes? Do team members have to manually update a spreadsheet to keep track? Who has approval for specific payments, and do teams understand these rules? Business budgets go hand in hand with spending management. The solutions are probably not fully clear. In addition, many organizations rely on laborious procedures and conscientious personnel to keep expenses under control. Instead, investigate appropriate expenditure management tools. These relate your finances to your spending habits. As a result, you may have debit cards with budget-relevant restrictions and procedures that keep the right budget manager in charge of each payment. Most significantly, every payment is tracked, eliminating the need to maintain Excel spreadsheets. This is corporate expenditure for finance teams that require control without becoming oppressive.
I hope you enjoyed this video, and before leaving, if you have not already subscribed this channel, make sure to subscribe, like and hit the bell icon to get updates when I post new videos. Provide your feedback in comments. You can download material from the below links under video.